Welcome back. In this lesson, we'll look at what technical analysis is exactly, contrast it with the other ways of analyzing the markets, consider the assumptions behind it, and explain some of the reasons why you may want to become a technical trader. The methods that traders use to analyze markets and consequently make trading decisions falls into two very broad categories: technical and fundamental analysis.
Great, looking forward to it. So, remind us again, what is technical analysis?
Technical analysis is a way of evaluating securities through the study of statistics generated by market activity, such as past prices. It's important to understand that technical traders aren't trying to measure a security's value, but instead they use charts and other tools to identify patterns from historic data that might help them form an opinion about potential future price movements.
Just remind us again what the difference is between price and value.
Well, price is what you pay, value is what you get. Technical traders aren't only interested in the price movement in a market. Technical analysts are looking at these and trying to determine the direction or trend that prices may move in.
So, in other words, technical analysis attempts to understand the market by studying market activity itself, as opposed to the individual components that contribute towards it, or the factors that influence it.
Exactly. That's a good explanation. Let's recap on the other type of analysis. So, what do you remember about fundamental analysis?
Well, if I recall correctly, it's useful to contrast it against technical analysis. Fundamental analysis involves analysing the factors that impact the value of an asset. Once the analyst has a view on value, that is compared to price to work out whether the supply and demand of an asset might change. Is that right?
That's exactly right. This type of analysis is used to gather an overview of an asset's value in order to determine where the price might be heading. The assumption fundamental traders make is that price will eventually gravitate back to its value. So, for example, analysts looking at currencies and indices typically use a top-down approach and study macro fundamentals like a country's GDP growth, unemployment rate, and inflation prospects. How these change impact their views on value. When analyzing individual company shares, analysts may also conduct a bottom-up analysis, which is likely to look at the characteristics of a company in order to calculate its value.
Okay, I think I'm following. Could you give us an example to provide some context?
Sure. Okay. Let's say a trader analyzed a drug company's products and recent patent registrations and realized that they have a bumper new drug about to launch that cures male balding.
I'm all ears.
Using their valuation methods, the trader values the company at £25 per share. Then they look at the stock market and see that the company's share price is trading at £4. Fundamental traders would view this company as underpriced and an opportunity to buy something worth £25 for £4, depending on how confident they are in their analysis. With this type of analysis, traders are trying to work out the why behind a valuation.
I understand. So we could say that fundamental analysis is a direct contrast to technical analysis where traders aren't concerned with the why.
Exactly. The two types of analysis take opposite approaches, but each have the same end. That is, to help predict where the price might go in the future. One last point I would like to make about the two types of analysis is that just as there are many investment styles on the fundamental side, there are also many different types of technical trader. Some rely on chart patterns, where others use technical indicators, with most traders using a combination of the two. In any cases, technical analysts' exclusive use of historical price is what separates them from their fundamental counterparts.
Got it. So even within the different classifications of technical trader, there are other variations that define them further.
In a word, yes. Unlike their fundamental counterparts, technical analysts don't care whether an asset is undervalued. The only thing that matters to them is a security's past trading data and what information the analysis can suggest about the future.